Hi traders, and welcome to the Market in 3 with me, John, Senior Market Analyst here at Anzo Capital. I'm here to take you through all the FX news that could affect markets, as well as come up with some key interesting ideas for you guys to look out for. So today we're going to be talking a lot about what's going on in the Middle East. Obviously, it's an important topic for the market at the moment because it's causing so many issues. But we're also today going to talk about euro US dollar and the key levels to watch out for going into the ECB interest rate decision today or tomorrow, probably tomorrow. Let me just check my pro economic calendar here. Yes, tomorrow. So we've got the ECB decision tomorrow coming out. Expected to see a hold at 2.25%. So we're going to go a little bit through what's going on with the euro US dollar at the moment and some key levels to watch out for with regards to that. But before that, we're going to go through some chart checks. Now, looking at the markets recently, what's really interesting to me is that the volatility index isn't high. So the volatility index measures the volatility of the S&P 500. Now, obviously, the war risk causes a lot of tension and a lot of volatility within the markets, a lot of volume, a lot of risk in the markets, and we usually see traders go to more defensive markets in those types of environments, right? Now, when we look at when this war kicked off, so if I just go to Brent crude oil, obviously we can see that when the Iran war kicked off, that was around about the 2nd of March 2026, and we started to see a big rise up in March. We saw a huge rise, really, from the $80 a barrel all the way up to $117 a barrel. And when we look at the volatility index around that same time, so around the 1st of March, we can see that actually, the market at the time, where are we? April, March, we saw volatility surge massively, right? So we were trading at sort of 18.2 and we headed all the way up to 35.30 on the volatility index, which showed massive increase in volatility, a massive move to risk off, and we saw huge rises. The VIX now is at 17.15. So even though the escalations are continuing, right, and we see that it's been the 11th consecutive day since the bombing has continued and the resumption, right? So the ceasefire has been over. So we had 11 consecutive nights of strikes against Iran. We've now had Iran come out warning that if the US try to, put boots on the ground in Iran, they will fight with all they can. So the escalations aren't necessarily calming down, right? But the volatility index is still only at 17.15. So something's off there, right? It's almost like, the market is just ignoring or beginning to ignore the volatility from the war. And the only markets it's really impacting at the moment is your oil market, your sort of yields, your gold prices, right? Even though gold has actually, started to break higher, considering the fact that US yields have been rising again, which usually they do the opposite effect. So again, something a little bit weird going on in the markets. We're not really seeing that big punch up in volatility that you would necessarily expect as these war headlines continue. If we go take a look at what happened in March of 2026 and the S&P 500, this is a 4-hour chart, you can see that prices moved from around $7,000 all the way down to $6,300. There's a $700 drop in the US stock market, which would have wiped millions off. And yet we're in a situation where escalations are, really ramping up. And the market's not really taking much notice, in my opinion. Volatility index is still fairly low. Anything below 20 is usually a good thing. And anything above 20 can mean volatility is around, but usually it's a good buying opportunity for the stock market, right? When you look at the volatility index and we look at all these spikes above 20, and then we compare that with the S&P 500, right? So if I just add that onto a new price scale, and I'm just going to change this to a line chart. And you can see when I overlap these two together, I might actually put this on a new pane above just so you can see it. Move to a new pane above. Right. Let me just get rid of the stochastic down there. You'll see that when we have a huge sort of rise in the volatility index, so let's take this example here, Friday the 17th October 2025, volatility spiked up from 20 to 25.32. And look at the low that formed in the market, right? And then we saw the S&P 500 go on a big rally as volatility was ramping up then. So it went from the 16s all the way back up into the 27s. Look what happened to price. S&P 500 fell, but then it formed that big low. So once we kind of peaked at 26, market started, volatility started dropping, S&P 500 moved higher. Now we're getting into the sort of the war area, which is like sort of February 2026, March 2026. We had a consistent climb in the volatility index. That's what caused that downside move in the S&P 500. Now, looking at it now, it's fairly calm, right? I mean, considering all the facts that we have, big fear in the markets and X, Y, and Z, doesn't really seem like the volatility index is matching up with that and matching up with that kind of fear sentiment right now. Now, one thing that I do also like to look at when it comes to measuring fear is looking at the CNN Fear and Greed Index. But I'm going to talk a little bit more about that in depth tomorrow in our upcoming, Friday, in our upcoming live stream, talking about how to trade fear. But this is a really good example of how the market is kind of, shaping up for a bit of volatility. Now, we do have the volatility index trading at above the 50 moving average at the moment. That is how usually market volatility is measured. However, we're in a little bit more of like a neutral territory versus a market that is expecting high volatility. Now, it might be down to a few things. We are coming into the summer period as well. Usually volatility does stay a little bit lower in the summer periods. But I just find it fascinating that we are seeing a volatility index that is very, very low, considering the fact that we are starting to see this real escalation. Now, things that change that probably is if we do see boots on the ground from the US in Iran. If we see that and then we see an invasion, that then would probably see a big spike up in that volatility, and we probably will see the S&P 500 drop much lower. So it's quite interesting to see how this one will play out. If I just look at the, I want to just bring up the volatility index as well. We can have a little look at the VIX futures on a seasonal point of view, right? Because I was looking at this and I found this fascinating too. So VIX futures, over a 20-year period, we only have a 24% correlation with current price. Let's see if we can get anything different. So all years we have a 43% correlation, which is better. I prefer it 50% or above using this software with Markets Made Clear. It suggests that you should look for 50% and above. Now, when I hit something called True Path, it shows me all the years that are following a similar year to this one. And the only one is 2000. So we don't really have a lot of data to go with here. Okay. So, I might just get rid of true path here, because that's not enough information. We are in a midterm election year, but again, not really got a very strong correlation. They've got a -8% correlation. Does that mean that prices of the VIX are not going to match the seasonal patterns? No, it just means that the current correlation isn't there. But check this out. So I'll put the midterm election one on. I'll put on the all years seasonal pattern on, and I'll put the 20-year seasonal pattern on. Now, all of them point to some kind of low coming in July, and seeing volatility ramp up between July and October. Okay, so are we going to see something similar again here for the volatility index, considering the fact that it's so low and all these escalations are around? Crazy. I think that we should see a volatility index that is pushing higher, stocks coming off those current highs, seeing stock markets dropping lower, and see a big move to the downside in stock markets, because inflation, or you watch yields are rising. That means that inflation expectations are going to be higher. That means that there could be some pricing in of rate hikes sooner by the Federal Reserve, and that could impact that volatility. So seeing that like that is crazy. I think I'm looking to see the volatility index would spike. Now, I might not necessarily be looking at it from a view of selling the S&P 500, but like I said before, once we get above 20, there can be positions that you can take in order to sort of check out the opportunity to be a buyer of the S&P 500. And it's a very famous strategy that you can use. I remember we talked about this a while ago, that actually one of the best strategies I thought coming into a presidential, into President Trump's second presidential run, was the fact that we should be looking for that volatility to increase, because we know he likes to get on, he likes to tweet, he likes to say rash things, he likes to put tariffs on people, he likes to be vocal for America. So that causes a lot of volatility. And two things that really sway currency markets and markets in general is you have the fiscal policy, right, and you have monetary policy, right? So when you look at that, fiscal policy is basically your government and what the government is doing. The government spending, are they taxing, are they increasing taxes, Then you have monetary policy. That is what your central banks do. So you have, in FX, you have two sort of big factors that drive markets, right? Now, some people call it the sort of geopolitical, and some people call it the macro, right? But it's all kind of these things, and the market will favor one over the other from time to time. Now, obviously, back in March, from February and March, with the Iran war, that a lot of uncertainty came in, volatility rose. That was the geopolitical side of things taking over, or even won't necessarily say the fiscal side there, because it's not necessarily to do with Trump taxing or increasing government spending or anything like that, but it's more of a geopolitical wheel within the macro matrix that really drove prices. Now we're looking at it, and it's still the Iran escalation, but obviously that is still downplaying a lot of what's going on here. So yeah, it'd be interested to see where we go with the volatility index. I'm looking for the VIX to spike higher. If it does, the S&P 500 could fall. US dollar could remain a little bit stronger in that case. And perhaps we could even see some opportunities when it does spike. Sorry, that's my news squawk on. Let me just turn that down. Okay. So let's move on to the big story then. So the big story I wanted to talk about and discuss today was obviously the upcoming ECB meeting and the expectations of that. Okay, so let's go and have a look at Euro US dollar as well and look at some of the key levels. Now, Euro dollar may, again, might not be the market to watch in terms of this move, because we've got a lot of action with the US dollar as well. If I take a look at this daily chart here, the overall trend for the Euro US dollar price is down, right? We can see that we've traded from this 118 handle, and we've consistently made lower lows and lower highs recently broken through the 114.50 handle, and we've kind of failed to break back above, and the market has started to move to the downside. But pretty much we've moved within, a very, very tight trading range, right? So if I take a look at the range that we've traded in since the 24th of June, it's been in 104 pip range, right? So there's not been much movement on euro dollar since the 24th of June. So nearly a month's worth of just kind of sitting around. It's waiting for a catalyst, really. It's waiting for a big driver to take the markets higher. Now, if we look at the sort of technical analysis of it, we've got a couple of levels that we can look for. We've got this kind of counter trend line, which is basically a supporting trend line. If price breaks through that, that could offer some further downside to the market. But like I said, we've got a big event coming up. That big event is the Euro ECB interest rate decision, which comes out on Thursday, 1:15 p.m. GMT. So if you take a look at the ECB interest rate decision here, we can see that we are expecting them to leave rates at 2.25%. So that's a deposit facility rate here that you can see. Now, if we go to the interest rate tracker, we can have a little look at those expectations in a little bit more detail, right? So the ECB is expected to hold at 2.25%. They have an 86.2% chance of a hold, right? So very high chance that the markets or the probability is going to hold. There's a 13.8% chance that we get a hike. And the reason that is because of those higher energy costs, right? Oil, gas prices going through the roof because of what's going on globally. So every central bank is kind of in a very similar boat right now, is that they are monitoring inflation just in case they need to act, right? So what we've seen from a lot of central banks is they're positioning themselves just to hold rates where they are so that they have ability to maneuver with rates in the future if they need to. Okay, so there's a little bit of text here that we can go through here. It just says that the majority of ECB bankers are neutral: dovish 0, neutral 12, hawkish 6. The overall tone is neutral because the majority of ECB policymakers are leaning neutral, with 12 out of the 18 showing the bias. Recent comments reflect a balanced approach, acknowledging both upside risks to inflation, downside risk to growth, particularly in light of geopolitical tensions and tightening credit conditions. While there are concerns about inflation's remaining above target and the need for vigilance, there is also recognition of the fragility of the economic outlook, suggesting a cautious stance. The ECB's recent surveys indicate a tightening in credit standards and a decline in housing loan demand, which could weigh on growth. Overall, the language indicates a preference for maintaining the current policy stance while closely monitoring economic developments, which align with a neutral classification. So what we're seeing here is actually a very neutral stance from the ECB, potentially coming forward. Now, what we're going to have to wait for is the press conference. What is ECB's President Lagarde going to say in that press conference? Are we going to see, comments saying we need to really monitor inflation? So we can have a little look at a few reports out there. It's one report that I really like to look at is ING, right? Really good. If you're looking to try and get into macroeconomics and things like that, go and research different news sites, different banks, things like that, different markets. So ING have come out with July ECB cheat sheet. No lull in sight. We expect rates to hold steady on Thursday, but what was meant to be a quiet meeting may evolve into a hawk-dove tug of war against the backdrop of renewed escalation in Iran. We think the policy message should be a focus on preserving market pricing with hints of a September hike. So that's what we really kind of see. Is this inflation going to be worrying ECB policymakers enough that they potentially hike rates in September? That's what the market's going to be trying to look for and potentially going to try and kind of post in. And they've done this really nice graphic here that we can look at, right? So this is the scenario analysis, how to position for Lagarde's alternatives, right? So you can see here we've got inflation outlook. Current stance is that upside risks due to higher energy prices, second round effects possible. Growth outlook, risks are still tilted to the downside, especially in the near term due to the Middle East war. Interest rates, the deposit rate at 2.25%, data dependent, meeting by meeting approach, right? So this is ING's outlook. They reckon that the latest re-escalation is bringing fresh upside risks in inflation, okay? While downside risks persist, a variety of indicators have improved. On the growth outlook and on interest rates, they're going to hold, implicitly signaling another rate hike is the baseline scenario. So they see euro US dollar 114 flat. If we go take a look at euro US dollar right now, we are currently trading at 114. So they don't expect necessarily much movement out of the euro US dollar in this move, because markets are pretty much expecting that. Now, there is obviously a dovish, neutral, and very hawkish stance that can be taken, which is something that we always want to look at. So when we're looking at a dovish tone from the central bank on inflation, it means that recent easing in energy prices has reduced the risk of persistent inflation. How likely is that current in terms of the current escalations? That's probably very unlikely, right? Growth outlook, downside risks for growth have increased, should linger even after peace, right? Interest rates hold, must be careful not to over tighten. Implicit hints June was one and done. So that's the kind of dovish view. And if that's the case, they expect that euro US dollar trades down to around 113. When we look at the very hawkish side of it, I'm going to ignore the neutral because I don't think we're going to see that. But if we go to very hawkish, that's inflation impacts likely to be bigger than initially thought, requiring immediate action. So they're expecting that the very hawkish side is that they hike in this meeting. The 25 basis points hike comes in this meeting. On the growth outlook, explicitly prepared to accept growth impact to prevent a repeat of inflationary crisis. So basically, they're happy to increase interest rates that impacts growth to try and prevent inflation from getting out of control. Interest rates, 25 basis points rate hike, retaining optionally to a hike further by staying data dependent. So those are your big outlooks here. So, and they expect that if we do see that very hawkish tone, that euro US dollar could trade up to 115, which is around about these lows that formed on the 8th of June. So we've got two scenarios in play. If we see a interest rate hike and a very hawkish ECB, then we are probably going to rip higher and head towards that 115 handle. If, however, we see a very neutral or an expected tone, which is basically the recent oil moves and energy moves are going to be a problem, could potentially be problematic, but they need to remain data dependent. That's pretty neutral. So, you know, a hold and that probably doesn't see much movement. However, on the dovish side, if they say that actually, you know, we're not going to cut rate, we're not going to hike rates in the future, we think we've done one and done, then we could see some further downside to euro US dollar, potentially down into the 113 handle. So keep that in mind when you're looking at that interest rate decision coming tomorrow. Some big decisions could be made, and we're expecting maybe some volatility if we do see a deviation from the norm. And that's what it's always important to look at when you're looking at trading markets and trading news and fundamentals. What's the deviation, what the market is trying to price in, and where is that deviation? So let's move on to the skill of the day. So we didn't do a skill of the day yesterday because we were so focused on what was going on in the Middle East. We're going to do a skill of the day today, and we're going to talk a little bit about using seasonals in your trading. Okay, so seasonal patterns I showed you a little bit earlier with the volatility index. I'm going to show you a little bit more about seasonal patterns now, because there are a few seasonals out there that can be pretty cool to look out for. So let me move this on to the skill of the day. So I'm using a platform called Markets Made Clear. This is a paid platform. There are other platforms out there. So just to make that in mind, there are free ones out there as well. So one big one that you can look at is something called Equity Clock. And Equity Clock also do outlooks on seasonal patterns. So I'm going to show you the free version first, show you why that maybe you should look at a paid version. But, you know, let's check out the free one first. So let's check out Equity Clock. We're going to hit the seasonality thing here, and you can see that it's going to give us a little bit of a blurb here. So basically, seasonality refers to particular time frames when stocks, sectors, indices, FX, commodities are subjected to and influenced by recurring tendencies that produce patterns that are apparent in the investment valuation. Okay, so seasonal patterns are very, very common in the markets, and some big funds out there actually use seasonal patterns for their trading. So I'm just going to go to charts. I'm just going to pick a chart out here, and we're going to stay more on the FX side. We can have a little look at some of those as well, but we are going to stay FX side, and then we're going to choose the pound because the pound has a very strong seasonal pattern through March and April. Okay, and it's very, very common. So what we have here is a seasonal chart. Let me just get a pen tool up so I can try and annotate on the chart for you. So we can see here, March, usually we form a low. Now, what this chart is showing us is British pound futures, okay? Now, what it's also showing us is a 20-year range, which ended on the 31st of December 2025. So it's basically looking at a 20-year period of British pound futures, the average move of all those moves, pulling it into this line chart, okay? So what we're looking at is how effective this is, right? So if we look here, March typically finds a bottom, but through April, usually we get a very strong positive surge in British pound futures markets. Now, it could be down to similar a multitude of things, right? But the tax year in the UK ends on the 5th of April. So there could be something to do with the fact that actually there is a big tax reason of why we see huge moves in the British pound futures around April time. Okay, so that is fascinating. And if you know that, you could potentially trade it. So there is a nice big move that comes in pound. Now, you can see here, this information here is good. It's good, but it's quite basic, right? Now, if we take a look at markets made clear, we can get a bit more information, right? So I'm going to go to the British pound sterling here. I'm going to take a look at the seasonal pattern, right? So let's have a look at this one. So here again, we've got multitude of different things we can look at. We've got the 20-year seasonal pattern, but what I really, really love and value in this platform is that it shows us the current year, right, versus the seasonal averages. So the 20-year only had an 8% correlation, right? But just for argument's sake, look what happened to pound in April this year, right? April 1st came all the way to May 1st. Look at the pound price this year, which is the green line. It literally formed a low and rallied. Amazing, right? I think that's really fascinating. Now let's go take a look at something else. So I can take 20 years off and put all years on. So this information goes all the way back to 1976. And again, that pattern still recurs, right? You can see that we have a very strong seasonal pattern. And when you compare it to all years, it has a current year's price has a 71% correlation with that. Now, what's fascinating as well is the software points out these key areas. So you can see I've just clicked on this blue bar here. And if I scroll down, it gives us some more information. Basically, that pattern from 1976 to 2025 has a 72% win rate from the 1st of April to the 20th of April. It tells us that on the average, price can gain 1.4%. The max profit from that has been 4.6%, and the total return over all those years has been 35.2%. That basically is telling us that over 50 years, there's been 36 winning years and only 14 losses. And the last time we saw a loss was in 2024, okay, which is quite a deep one. It was a minus 1.4 average loss. But still, look at this. We've got that very strong correlation between all years and the current trading year. And in April, price found a low. Now, just to prove that, because you're looking at this on the software, you might think, did that actually happen? Let's go to pound US dollar chart. Okay, so here's the pound US dollar chart. You can see that I've marked up the 31st of March here because that was actually a very strong pattern as well in the market. But what I want to show you is this. Look, 31st of March, price came into a key weekly support zone of 132, 131.50. It double bottoms, it rallies through April, and then it reaches a high on Friday, the 1st of May. So as a trader, that is invaluable information, because you could be looking at that saying, well, I know this pattern recurs over time. Looking at the software, it shows me that there is a strong correlation between the current year's pricing and all years, so all 50 years pricing. That is a trade idea. That's how you can come up with the trade idea. And that is a skill that you can earn and have in the markets. Now, like I said before, you don't have to use a paid service like this one. There are other services out there. Equity Clock is a really good one that you can take a look at when it comes to seasonal trading. So thanks for watching the stream. I hope you enjoyed it. If you did, give it a thumbs up. Subscribe if you are new around here. My name is John, Senior Market Analyst here at Anzo Capital. I'm here to bring you lots of insights into the FX markets. I also am here to teach you new skills. So stick around and subscribe. Thanks for watching. Speak to you soon.
On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.